The Federal Reserve gathers today facing a situation unseen in recent decades. They can't lower rates, they can't raise them, and they can't openly explain why oil has climbed to $100 a barrel. Inflation sits at 3.1%. The economy is losing momentum. And the leader of the planet's most influential monetary authority finds himself under criminal scrutiny from the very president set to appoint his successor. The Fed stands frozen in place. In public statements, they'll insist everything remains on track. Behind closed doors, the numbers have already dictated the outcome. Meanwhile, gold has been steadily soaking up the unspoken message the Fed can't voice. And it's now poised to launch into the stage of its price history that delivers the most dramatic surges. By the time Powell wraps up his press briefing today, the markets won't just react to the rate choice. Everyone already knows what that will be. Instead, they'll deliver their judgment on something far bigger, whether the Federal Reserve retains any real flexibility left at all. And, according to Dalio, the answer is no. Yet the true narrative goes beyond the rate pause or the media session. It's about what this FOMC gathering uncovers regarding our position in the three-stage gold bull market, and why the stage kicking off right now has a track record of delivering gains that make the opening act seem like mere preparation. Dalio's take on the Federal Reserve's bind, shared on March 18, 2026, stands as his sharpest analysis of central bank gridlock in 4 decades of observing how institutions grapple with the unforgiving arithmetic of late-cycle debt. What he highlighted about the gap between a central bank that opts to maintain rates and one compelled to do so, and the implications for gold, bonds, and every dollar-based holding, deserves attention from every investor ahead of the briefing's close. Subscribe now. Here's precisely what's unfolding at the Fed today, and why the gold market has already grasped what Powell won't state plainly. At 2 p.m. Eastern today, March 18, 2026, Jerome Powell will step to the microphone and declare that the Federal Reserve is keeping interest rates steady in the 3.50 to 3.75% range. CME Fed Watch priced the odds of this at 99.2% this morning. Not a shock, not a genuine call, but a foregone conclusion driven by the math. But the figure that truly counts isn't the rate itself, it's the bind. On one flank, core PCE inflation registers 3.1% year-over-year as of January 2026, with a 0.4% monthly uptick, heading the wrong way at the most awkward time. Brent crude spiked to an intraday high of $126.50 per barrel in the period following the start of Operation Epic Fury on February 28th. Each additional dollar in oil price piles cost-push strain onto an inflation gauge already 55% above the Fed's 2% goal before the initial strikes on Iran. On the opposite side, Q4 2025 GDP growth registered a mere 0.7%, plunging from 4.4% in Q3. Unemployment holds at 4.4% and continues climbing. Manufacturing has shrunk for 9 straight months. American households face roughly $1,500 each in added tariff expenses, plus $60 to $150 monthly in electricity surcharges tied to the Canada trade tensions. And now early signs of oil-fueled rises in gasoline and food costs are starting to appear, though not yet fully reflected in CPI readings. Slash rates to counter the downturn, and you risk reigniting inflation already intensified by oil. Maintain rates to tame inflation, and you hasten the slowdown fueled by 126 oil and 4.4% unemployment. Lift rates and you risk exploding the $9.2 trillion in Treasury debt slated for refinancing this fiscal year. Debt already generating $1 trillion yearly in interest costs. No alternative path exists. The Fed is cornered. Powell, currently under DOJ criminal probe for declining to slash rates at the president's urging, will address the room in phrasing so meticulously balanced that most listeners will miss the underlying reality. Gold picked up on it months earlier. Here's where the stakes sharpen. The key number isn't 3.1% or 99.2%. It's $245 billion, the red ink the Federal Reserve has logged on its balance sheet since 2022. A shortfall the central bank can legally label a deferred asset instead of insolvency, since it sets its own bookkeeping standards. To put it plainly, the Fed currently pays banks 3.65% interest on reserves exceeding $3.3 trillion parked with it. Yet the treasuries and mortgage-backed securities acquired during COVID yield well below that. The Fed is essentially covering premium rates for subpar holdings. Outcome? $245 billion in total losses. By any standard private sector accounting, this central bank is technically insolvent, not a minor discrepancy or mere footnote. The steward of the global reserve currency has posted losses for 3 years running, carries them as an imaginary asset, and now must steer through the trickiest stagflationary setup since 1979. Lacking the conventional levers past chairs relied on, because those have already been exhausted. Back in December 2025, the Fed quietly began injecting about $40 billion monthly in fresh liquidity to acquire short-term treasury paper. They avoided calling it quantitative easing, labeling it instead reserve management purchases. No announcement, no press event, no releases to reporters. They simply proceeded. $40 billion created from thin air each month to support government borrowing the market wasn't digesting quickly enough at prevailing yields. This marks phase 2, underway for 3 months now. Ray Dalio has devoted 4 decades to pinpointing the precise shift when a gold bull market moves from phase 1, the measured institutional adjustment period, into phase 2. That's the stage, propelled by the broader market's awakening to the fact that the central bank can no longer steer the monetary system without picking between twin paths of damage. His model is exact. Phase 1 drives consistent, deliberate gold gains as sovereign funds and central banks discreetly trim dollar holdings. Central banks acquired 1,037 tons in 2023, 1,045 tons in 2024, and 863 tons in 2025, each year roughly double the long-term norm. Purchases persisted annually, despite climbing prices, with each additional ton costing more. Phase 1 prioritizes positioning over price levels. It concludes not when buying halts, but when everyday market participants grasp the motivation behind it. Phase 2 ignites with a defining trigger, not the crisis per se, but the recognition that conventional central bank responses won't suffice. In 1971, Nixon shutting the gold window. In 1979, Volcker confronting the choice of crushing inflation via 20% rates or crippling the economy with the same. In 2026, it's this March 18th FOMC session. Rates held at 3.75% amid $100 oil, 3.1% inflation, GDP sliding to 0.7%, and an incoming chair selected because the president expects aggressive cuts, irrespective of data. Phase 2 isn't the moment the Fed actually unleashes printing. It's when markets decide printing is unavoidable and start baking that inevitability into gold prices ahead of time. First layer, the unforgiving arithmetic of the $9.2 trillion debt rollover. The U.S. must refinance that massive sum this fiscal year at prevailing 3.75% rates, pushing annual interest to $1.03 trillion, the first time it has surpassed the full defense budget. Raising rates to combat oil-driven inflation would balloon refinancing expenses by tens of billions per quarter point increase. Holding steady with 3.1% inflation leaves real yields negative, eroding value for foreign holders of $7.6 trillion in U.S. bonds faster than payments compensate. Cutting to bolster growth would pour fuel on inflation already beyond the Fed's comfort zone thanks to oil. Every route carries a price, ultimately undermining dollar confidence. Second layer, the Walsh succession dilemma. Kevin Walsh assumes the chair in May 2026, tapped by a president who has openly pushed for rates at 1% or below, including a recent Truth Social message on March 12 questioning Powell's whereabouts and directing DOJ subpoenas. Walsh has labeled the Fed dysfunctional, and called for overhaul, aligning his views with the administration's push for lower rates. Upon taking over, markets confront a clear fork. Will he cut amid oil-fueled 3.1% inflation, or defy his appointer and stay firm? Either choice solidifies phase two. A cut signals eroded independence and the start of debasement. A hold validates the stagflation trap and looming recession. Gold benefits regardless. The only variable is timing. Third layer, the private credit powder keg. Historically, phase two catalysts emerged from the financial sector rather than government. 1929 brought the stock crash, 2008, housing. In 2026, the opaque, highly leveraged arena is private equity and credit, commanding $4 trillion in assets, including $440 billion in decade-old zombie funds unable to exit positions. These vehicles rely on continuation tactics, flipping assets internally and borrowing against optimistic valuations, to defer loss recognition and stave off redemptions. When recession, rising defaults, or the credit cycle forces those losses into daylight, they spill into lending banks. Those banks, already earning negative real returns on Fed reserves, will require rescue. Only the Federal Reserve can deliver it, using the very mechanism it quietly activated, $40 billion monthly in reserve management purchases. Dalio framed it this way in his analysis of Phase 2 gold behavior and eroding central bank trust. Over 40 years navigating every significant monetary shift, one reliable indicator has marked the entry into gold's most potent stage: the market's acceptance that the central bank no longer selects its response, but merely times an inescapable result. This awareness builds gradually through accumulating clues. A rate hold when easing is warranted economically. Liquidity creation rebranded to sidestep the term printing. A criminal probe into the departing chair, a successor whose autonomy faces open doubt. These pile up until denial becomes impossible. Today's March 18th meeting won't deliver surprises, just a rate hold. But the message within that pause, the Fed caught between inflation and slowdown, saddled with $9.2 trillion to refinance and $245 billion in self-reported losses, serves as the Phase 2 indicator. Gold has anticipated it for 3 months. Broader markets are about to align. He drew parallels to 1979, not identical but illuminating. Volcker took over a Fed stripped of credibility after prolonged easy policy. His 20% rates inflicted severe pain, tolerable politically only because unchecked inflation posed worse danger. The 2026 Fed confronts a comparable credibility crisis under different limitations. 20% rates would impose $7.2 trillion annual interest on $36.2 trillion debt, 5 times the discretionary budget. Open printing would turbocharge oil-embedded inflation to politically untenable heights. So it follows history's pattern in such binds. Operate discreetly, rebrand printing as reserve management, treat insolvency as a deferred asset, hold steady while claiming stability. Gold, free of balance sheets to finesse or briefings to script, simply reflects the divide between official rhetoric and inescapable math. In closing, Dalio noted, across 40 years observing Phase 2 unfold wherever central banks lost discretion over conflicting goals, the pattern holds. The 1979 Iranian events pushed oil past $40, triggering gold's 276% surge in 12 months. Not from panic buying, but because monetary math rendered dollar debasement inevitable. Gold prices that certainty ahead of any admission. What unfolds on March 18, 2026, rates held at 353.75% with oil near $100, core inflation at 3.1%, GDP at 0.7%, and a successor nominated by a president demanding 1% rates, embodies every Phase 2 marker. Collectively, they form the clearest such setup in 4 decades. Gold trades around $5,100. Analyst targets from J.P. Morgan, Deutsche Bank and Goldman Sachs point to $5,900, $6,300. That spread isn't speculation. It's the calculated result when Phase 2 confirmation lands, which this Fed meeting will provide, intended or not. Market indicators validated the entire framework even before the statement dropped. Gold opened March 18th near $5,085, respecting the Phase 2 support level Dalio flagged 3 weeks prior. The gold-silver ratio at 57 hints at silver's potential for amplified gains, typical in Phase 2. Gold miners, whose profits can triple on a 50% metal rise due to fixed costs, still trade 20% below fair value at today's prices because mainstream retail hasn't embraced the thesis yet. 10-year Treasury yields lingered near 4.14%, ignoring the usual safety bid that lowers them amid stock turbulence. That stubbornness isn't random. It's Phase 2 in action, with bonds factoring in the refinancing load, Fed losses, and oil pressures, demanding higher premiums for long-term dollar exposure. The dollar index dipped toward 98 after December jobs data and has fluctuated since. A currency failing to rally in crisis, contrary to precedent, signals its safe haven status is under review, another Phase 2 cue. Among miners, shares outstanding in GDX fell 20%. Junior miners in GDXJ shed nearly a third, even as prices advanced. Retail remains sidelined while institutions hold positions. The divide between institutional readiness and retail awareness that defined Phase 1 accumulation now defines Phase 2. Some observers will view today's rate hold and see business as usual. Inflation under control, risks contained. They'll wait until Phase 2 gains become obvious to all. By then, most structural upside will have accrued to those who recognize the pattern early. Others will interpret the same hold as the embedded Phase 2 signal, a central bank unable to ease due to oil, unable to tighten due to debt, unable to print transparently due to inflation, replacing its chair under questioned independence, while quietly adding $40 billion monthly in liquidity under an innocuous label. This wasn't merely a Fed tale, an interest rate narrative, or a gold price story. It concerned the three-phase model that has shaped every significant gold bull market historically and the identifiable, verifiable instant when Phase 1 concludes and Phase 2 commences. That instant is today, March 18, 2026 at 2 p.m. Eastern, when the world's dominant central bank maintains rates because alternatives are unavailable. Gold, meanwhile, values the discrepancy between Powell's words and what the equations have predetermined. Phase 1 converted $10,000 into $35,000. Phase 2 in the 1970s gold run transformed $10,000 into $243,000. The question Ray Dalio poses, and the one every gold owner, silver holder, and anyone with dollar-based savings should consider today, isn't if Phase 2 has started. The math settled that. It's whether you're situated on the right side of that threshold when Powell steps down from the podium, because Phase 2 doesn't pause for official acknowledgement. It launches the second central bank paralysis turns indisputable. And at 2 p.m. Eastern today, that threshold is crossed right on cue. Most investors won't notice until the shift has largely passed. Now you have.